It's another week on Business Morning. Welcome to the program. I'm Chimeze Obi Iwago. Nigeria's gross domestic product declined by minus 6.10% year-on-year in the second quarter of 2020, ending the three-year trend of low but positive real growth rates recorded since the 2016-2017 recession. The decline was largely attributable to significantly lower levels of both domestic and international economic activity during the quarter, which resulted from nationwide shutdown efforts aimed at containing the COVID-19 pandemic. And when compared with the second quarter 2019, which recorded a growth of 2.12%, the Q2 2020 growth rate indicates a drop of minus 8.22 percent points and a fall of minus 7.97 percent points when compared to the first quarter of 2020. Consequently, for the first half of 2020, real GDP declined by minus 2.18% year-on-year, compared with 2.11% recorded in the first half of 2019. Quarter-on-quarter, real GDP decreased by minus 5.04%. Furthermore, only 13 activities recorded positive real growth compared to 30 in the preceding quarter. Our data released this morning by the National Bureau of Statistics shows the real growth of the oil sector was minus 6.63% year-on-year in the second quarter 2020, indicated a decrease of minus 13.80% points relative to the rate recorded in the corresponding quarter of 2019. Growth decreased by minus 11.69% points when compared to first quarter 2020, which recorded 5.06% quarter-on-quarter. The oil sector recorded a growth rate of minus 10.82% in the second quarter 2020. The oil sector contributed 8.93% to total real GDP in the second quarter, down from figures recorded in the corresponding period of 2019. The non-oil sector declined by minus 6.05% in real terms during the reference quarter. It was the first decline in real non-oil GDP growth since third quarter 2017. The recorded growth rate was minus 7.70% points lower compared to the rate compared to the first quarter of 2020. Nevertheless, non-oil sector output was driven by financial and insurance, information and communication, agriculture, and public administration, moderating the economy-wide decline. On the other hand, sectors which experienced the highest negative growth include transport and storage, accommodation and food services, construction, education, real estate, and trade, among others. In real terms, the non-oil sector accounted for 91.07% of aggregate GDP in the second quarter of 2020. That's slightly higher than the share recorded in the second quarter of 2019 as well as the first quarter of 2020. All right, to dissect these numbers, I'm being joined by the CEO of Financial Derivatives Company, Mr. Bismarck Rewane. And of course, I have here in the studio an investment professional, Robert Omotunde. Thank you very much, gentlemen, for coming on our show.
Thank you.
Right. Good morning, Mr. Rewane. I start off with you. Minus 6.10% decline. That's minus 8% contraction. Were you expecting this steep decline considering all the palliative measures and the sustainability plans of the federal government? This is quite alarming, right?
It is, let me put it, it is surprising and it's concerning. I don't know about it being alarming at this point in time. But the truth is that the economy had its pre-existing conditions in Q1, and that the slowdown, the lag between the slowdown and the contraction was underestimated by all analysts. To that extent, we are saying that the total contraction is about 7.97 when you add the 1.87% growth in the first quarter to the negative growth of minus 6.1. And what does this mean? This means that 7.97% of GDP is about 12 trillion naira, which is equivalent to the total budget of 2021. The palliative and the economic sustainability plan is actually for 2.5 trillion naira. So we have a 2.5 trillion naira equipment to fight a 12 trillion naira contraction. So you can see that the limitations and inadequacy and inappropriateness of the tools compared to the problem we have is it's stark. So to summarize this, we are saying that one, the slowdown So the move from a slowdown into contraction was more than we expected, that the tools that we have at our disposal are inadequate, that the stimulus that is required to take us out of this situation is going to be much more than we expected, and that we are going to have to take some measures. But basically, let me put it this way. We now are faced with what we call a quadrilemma. Quadrilemma means that you have four unpleasant options, and you have to deal with them. You have to deal with four unpleasant options. The first variable that we are looking at is recession, negative growth. The second variable we are looking at is high inflation. We have inflation almost at 13%. The third variable we are looking at is high unemployment. Even though the unemployment numbers are at 28%, we think that it's much more than that. And then finally, we have weakness in the currency. There's forex rationing. So we're having external weaknesses and vulnerabilities. We're having slow growth. We're having high unemployment. And more than anything else, we're having contraction in economic activity. Those are the things that we have to deal with. Now we are going to have to we have to move away from the monetary policy complement that we have. We have to stimulate the economy with greater catalysts, and we have to do some things differently from how we have known them at this point.
All right, Mr. Rewane. Now, all of these numbers, all of these figures, what does it mean for the ordinary man out there?
Well, unfortunately, the truth is that, first and foremost, let me state categorically that almost every country in the world is facing this, but that's not an excuse. It's not a race to the bottom.
Absolutely.
So it's a question of, we knew this, we knew that it was coming, that the steps we took were positive steps, but they were inadequate and inappropriate for this. So it's now time for what we call non-invasive invasive procedures. We can no longer treat it as a normal ailment. That is, what I would like to liken it is that a child that had single plus malaria now has 4 plus malaria. You are not going to treat the guy with a tablet. You are going to have to use drips and hospitalize that kid. What it means to the ordinary man is that you are going to be seeing higher unemployment. You are going to be seeing higher price of goods. You are going to be seeing an exchange rate adjustment, inevitable, that's going to happen. And you are going to see, like I said, higher inflation, slow growth, vulnerability in the external sector, and more than anything else, you will need to do something about productivity. There's no question about that. The problems aside, we knew the problems. We now know that the magnitude of the problems are much more. So we cannot expect anything different at this point.
All right. Now, Robert, from the investment point of view, how do you think the markets and investors should be reading this number at this time?
Well, I think that I think Mr. Rewane already dissected all of the issues around, the broader macroeconomic headwinds that the economy has been facing. As a matter of fact, since the 2016 recession, there were, steps that we should have taken that we haven't taken. And now this is the result. Like you said, we had an anemic economic situation, before COVID-19 came. The only drag here is that if we've been able to recover from the 2016 recession and we've been able to get ourselves back to, that 10-year growth trajectory that we had before the 2014 oil price crash, maybe we would have been at an 8%, 7% growth level, such that the number we are seeing now, even if it's negative, it won't be this drastic. That said, the investment space, already envisaged, or if you like, this is Q2 GDP data. We already saw the, purchasing managers index for manufacturing and non-manufacturing, which already indicated that Q2 numbers were going to come in negative. And by extension, given the July number we've seen for PMI and non-PMI, we are likely going to see that happen again in the third quarter. And then that's when we technically now declare that, okay, the economy is in a recession.
Yeah.
So if you look at most of the numbers that have been reported on the NSC, from the, activities of companies that are listed in that space, you will have seen, indication of all of this, or the number we are just seeing now on a broader economic perspective. Now, what that suggests to us is that the economy, like we will say, the stock market, for example, it's a barometer for measuring the economy. So what we've then seen is, because those numbers have come come in earlier, we already have a sense of what the broader economy would have done. Now, what investors will be doing at this time will be trying to study what the body language, or some of the policy responses of government will be to this particular data. Already it was expected, and I don't think there's anybody in government that wasn't expecting that will be negative, even if they don't expect that it will be this significant. Now, what we are now saying is that policy, response to this, let's say from the monetary policy side, will be, the central bank has been trying to tame inflation and to ensure that they stimulate growth at their own level. So what other steps they are taking to do that is what investors will now be watching. What will happen to interest rate now that we've seen that the level of growth, is even much more negative? That has been low anyways. It's just that we have a situation where, interest rates is not really responding to the growth of credit within the economy because there are other headwinds that, the banks are looking at before they create those credits. Definitely there are a lot of issues to dissect, but I think my initial thought will be that markets will look at what the policy response of, the monetary and the fiscal authority will be to these numbers.
All right, well, Mr. Rewane, you did mention that, of course, that Nigeria is in a quadrilemma. You mentioned the unemployment rate, the inflation numbers, exchange rate, and of course this data that we're seeing. Now, you are a member of the Economic Advisory Council. What advice would you give to the government at this point? What kind of quick fix do we really need at this point?
First of all, I will not advise the government on television, so we do advise the government in camera.
Whatever it is.
Okay. Number two is that we know for sure that the economy is in far worse shape than we can see. The difference between 2016 and now, 2016, we had 6 straight quarters of negative growth. But now we have a situation where policymakers are not in denial. Policymakers are the only question is the level, the dosage of the therapy that we are trying to adopt. So I have no doubt in my mind that we will get out over this. But let us first start by saying that what kind of recovery curve do we expect? The recovery curve that we expect this time is more likely, we had said before it's going to be a U curve, but we are more likely to see a W curve. Why do I say a W curve? We are going to see a drop, which we are seeing now. We are going to see a rise, but because infections are likely to increase, right? So when you have infections, then you will have precision lockdowns. So because of the rise in infections due to COVID, together with the drop in activity, we will then go back again. So all of these things have been taken into consideration. I think policymakers are not in doubt as to the ability and their capacity to respond quickly. So what do we expect to see? But first of all, let us go back to those sectors that grew the worst. The sectors that grew the worst were, as you can see, construction, 31% negative.
Yeah.
Trade 16.59 negative.
Yeah.
Transport 9.23. Accommodation and food services minus 40. Education minus 24. And real estate minus 29. So we need catalysts to do, and the catalysts are going to come in 2 forms. 1, government expenditure and government investment. 2, private sector investment. We need to now incentivize the private sector. It's not about words anymore. It's not about the ease of doing business. We now need to go back, like the petroleum bill, which is being discussed, the PIB. It's not. We don't have 6 months to wait for the National Assembly. It has to be done like yesterday. All of it done in 1 week. The National Assembly has to come back to work immediately to approve that. We need a package of incentives, that matching funds and all of that to get this done. Let me give you an example. The South African GDP stimulus was 10% of its GDP. Our stimulus plan is 2.5 trillion, which is about 2% of our GDP. Now we've seen that our contraction is minus 8%. It's about 12 trillion naira. The total contraction is the equivalent of the budget of 2021. So we need to almost double that and quadruple it. And we need to make sure that we get things going. And this includes, 1, adjustment of the exchange rate and sale of foreign exchange rather than rationing, because that will increase productivity. Adjustment of the exchange rate and sale of foreign exchange, significant amount of exchange rate, foreign exchange sales. Two, we need to immediately begin to look at the interest rate environment. Because as soon as you disperse this foreign exchange, there will be a shortage of naira, and that will push interest rates up. The federal government will have to raise money from the World Bank, the Eurobond market, everything to change up economic activity at the same time. You notice that, and then we now need to provide incentives for domestic investors as well, domestic manufacturers, the trade sector. We need to deal with the cost-reflective tariffs on power, because without power, you're going nowhere. So we need to have cost-reflective tariffs like tomorrow. We can't wait for another month. Cost-reflective tariffs, new investment there, restructuring that area. And also, the state governments also have to come to the party with major investment incentives. So it's a national emergency, an economic emergency. But when you contract, when you go from 1.87 positive growth in Q1 to minus 6.1, and I tell you that in the third quarter, it's going to be worse. We're already in a recession. Let's not wait for any official numbers. The third quarter, which we are in now, which will end in another month, in September, we are already negative. There's no question about that. So you are in recession, and it's going to go on. So the recovery, we don't expect the recovery till sometime in 2021. The time to take the action is now and immediate.
All right, thank you, Mr. Rewane. Okay, Robert. Okay, Mr. Rewane, of course, tried to paint some kind of silver lining there at the end of the tunnel. Hopefully, in 2021, we'll see some kind of recovery. He is looking at a W-shaped recovery. What sort of recovery are you looking at? Is it a U? Is it a V? Is it the same W? And of course, there's a new one, the K. One wonders.
I think I will most likely align with Mr. Rewane in terms of the shape of the recovery we're likely to see. And I quite agree with him that we're already in that recession, only that we are just waiting for the numbers to show it, And what this tells us is that, and I think he has alluded to most of what the government needs to do, and I'm glad that he touched on almost every aspect of the sector. And one thing that is different from this episode of, let's not forget, coronavirus pandemic slowed down economic activities. But more importantly, because our economy is oil dependent, it impacted on, the dynamics of the oil market. And that actually shaped the sort of activity or data we are seeing now in terms of the economy. What is different though this time around is that we've seen the government, especially from the central bank's perspective, take some very proactive steps. Remember, it took the central bank more than 2 years to realize in 2016 that the exchange rate was mispriced, that the exchange, the currency market was misaligned, and that in itself impacted on the, amount of, slowdown that we witnessed as at that time. I'm glad that, it was during this time that we saw the central bank aligning all the official rates, even though we still have about 20% gap to fill, because when you look at what the parallel market is reading at about 470 and what the official market is reading, we still have quite a number of gaps to fill. And this is because, like you said, we have a situation where we're rationing the exchange rate allocation, and we are not taking the full impact of what the demand is within the market. This again has the potential of further slowing us down, because if we learned from the episode of 2016, it got to the point where scarcity of exchange rate impacted on the activities that we see, especially in the service sector, which this GDP has further confirmed account for about 53% of our economy. Now, to have a drastic shift in the structure of the economy is not something that will be achieved overnight. It's a plan that the government must follow through. To this extent, the service sector still accounts for a significant chunk, and trade services, which of course is one of the major sectors that dipped this particular quarter, is one of the areas where exchange rate mispricing can actually affect in terms of how services are going on. So these are some of the areas I think that the government would need to focus on, but definitely the recovery will have to be somewhat W-shaped.
All right, talking about that exchange rate, I'm sure That's what we'll be looking at when we come back after this break. So don't go anywhere. And you, Mr. Rewane, stay there. Okay, we'll take a brief break. And when we come back, we'll still talk the economy. But this time, we'll look at the current developments in the FX market. To stay with us. All right, concerns around exchange rate administration has dominated the macroeconomic and investment landscape. Although unlike the events of 2016 during the last episode of recession, the Central Bank of Nigeria has allowed some adjustment of the currency during the current COVID-19-induced plummeting of the global oil prices. Now, these include the unification of exchange rate on all official window to the rate obtainable at the investors and exporters window. Yet, it appears scarcity of foreign exchange continues unabated, with the latest developments leading to banks reducing forex limits of clients by over 40%. Also, the spread between parallel and I&E market rates, which is currently over 20%, further buttresses the imbalance that still exists between demand and supply of forex. Okay, let's talk more about this. I still have with me Mr. Bismarck Rewane, CEO of Financial Derivatives Company, and of course in the studio, Robert Omotunde, who is an investment professional. Thank you very much, gentlemen, for sticking on. All right, let me start again with you, Mr. Rewane. Now, Robert Omotunde on the first segment talked about exchange rate misalignment. What is your broad-based assessment of Nigerian currency market in light of recent developments?
First and foremost, let's correct something. The exchange rates have not been unified. There's some convergence taking place. The unification is when you have a single rate. Secondly, in 2016, there was a supply disruption because oil prices fell, oil markets were in shock, and while the demand remained constant. The difference between this and this time and that time was that now we have both a demand and supply shock. In other words, the demand for foreign currency in Nigeria today is much less than what it was in normal times. But let us look at the supply side. The average price of oil in the second quarter was about $35 to $37 a barrel, even though our benchmark was $28. Today, the oil price is about $44, $45 a barrel, much higher than what it was in the second quarter. Two, the amount of activities. Even though oil contributes only about 11% to GDP, oil fuels almost all our international receipts. Therefore, we need oil money to fund our activities. So our oil supply has increased, and while the demand, the currency from the dollars we earn from oil has increased marginally compared to Q2. But our demand for foreign exchange now is being driven by speculation, fear, and anxiety created by the rationing of foreign exchange. The rationing does not help. Rationing gives the impression that there's a shortage somewhere. The truth is that our gross external reserves are about $35 billion. I think that that is adequate to cover at least the short-term shocks that we have. Therefore, if you put out, if you actually disburse significant amount of foreign exchange to the market after an adjustment, mind you, looking at what we call the crude PPP, the crude purchasing power parity price of the dollar to the naira today is slightly above 400, maybe 407 naira. If you did that, automatically the parallel market will actually contract, will actually appreciate, like we had in 2016, where we went from 520 back to 360, and further much lower, about 260, now 299. Now, what we are saying is that if you unify the exchange rates and then maintain its parity and its competitiveness against our trading partners, you will find that you'll be able to maintain stability and alignment going on forward. So, one, the demand for foreign exchange is not as high as it is being bandied around. Two, most of the demand is not speculative, but out of fear and anxiety because of the rationing. The rationing must stop. And then, thirdly, our terms of trade have actually, between Q2 and Q3, have actually improved marginally because the price of oil has gone, while the price of our imports have actually stayed stable. So I think that, generally speaking, if you put in as much foreign exchange to the market, let us say, for example, $3-4 billion put into the market, you would have increased productivity. And that increased output will help bring down prices. So it's the price shock that you have in the inflation. There'll be a pass-through, a little bit of pass-through, but right now, the customers, the manufacturers are already pricing their products at the blended rate of buying part of it in parallel market and part of it in the official market. There's no point deceiving ourselves. That is the truth. And that, as you can see that in almost all the imported products. But the economist hypothesis today is that because the demand for foreign exchange will reduce, the airlines are going to start flying in September, and they will not be flying with the same load factors. The demand for imported products is also going to reduce because we don't have the same purchasing power that we had in the past. So because of that reduced demand and complementing the reduced supply, the equilibrium exchange rate is not going to be where it is, where the parallel market is, but something much lower. And that stability and the stopping the rationing at the same time will help bring some stability to the market. And then that will be the beginning of the recovery of the economy.
All right, Robert, okay, he talked about the rationing, in the market. Now, a lot of people have argued that there are backlogs of, unmet foreign exchange demands that are currently pressuring the market. What is your estimate of this backlog?
Well, I think it depends on who you're talking to. Since, there are no really official data to really support what the actual figure is. Some would say it's $5 billion of unmet demand. If it's coming from the central bank's quota, they can tell you it's less than $2 billion of demand that has not been met. But I think one thing that speaks to the fact that there are backlogs is, Mr. Rewane mentioned the reduced demand at the official window. But when you look at what's going on in the parallel market, if it's indeed the rate we see at the parallel market is the price that is, equilibrated between the demand and the supply for foreign exchange. Definitely, there is a supply shortfall somewhere. And that's why you will see the parallel market as high as 470. Now, remember, there are items that have been excluded from participating at the official window. These are the items that play within the parallel market segment. Now, the point now is that if there is supply into the market, the supply in the official window feeds into the parallel market invariably. Now, but to the extent that we still ration and we don't supply that market, and he alluded to the fact that if we can pump in about $3 billion, dollars into the market, then it had some effect on what's going to go on in the parallel market. I also think that the parallel market rate is perhaps overvalued, or I would say, yes, overvalued at this time. When you look at 470, relative to what is going on at the I&E, I only just think that the equilibrating point may be something closer to 450 than 400. Now, the reason for saying this is because all the items that are playing within that parallel market space, if today you have to collapse the market, and everybody can participate at the official window, definitely you see some pressure come down, but that's also the condition on supply, into that market. Now, if that happens, and then you look at some other, you mentioned the PPP, methodology for deriving the exchange rate. And remember in this study, I've mentioned it before, one measure that I have found is very potent is looking at the supply of money in the system relative to the reserves. So currently today we're talking about $35.5 billion of reserves. Now, and when you look at the money zero maturity is just taking narrow money and you're adding some of CBN bills, that are outstanding to it. Now, when you add that and you do some extrapolation between the money zero maturity as a proxy for money supply and the reserves, you find out that the exchange rate you should get should be around 446. Remember, I was in this studio in February when exchange rate was at 360 and we were analyzing. And money zero maturity suggested at that time that exchange rate should be at about 400. It didn't take time before we got to that point. So that's why I believe that the effective, market-driven price of the exchange rate may be closer to 450. But it also depends to the extent to which the central bank is willing to spend its reserves. Now, as we speak today, when you look at bills outstanding, you convert at the official window, we have about $16 billion of bills outstanding, OMO bills, that are coming from foreign portfolio investment. Now, foreign portfolio investment is drying up. Now, but if the central bank if those guys were to take their money out today, about $16 billion will be leaving our system. But if there is an adjustment of the currency, and we have something around 400 or even 420, naira to the dollar, then you can see a much more lower pressure in terms of exits when those funds are to leave the system.
All right, Mr. Rewane, let me ask you, what is your fair value for the naira?
Well, that's what I'm trying to say. You see, first and foremost, the sale of foreign exchange, the ending of rationing must happen after an adjustment. The level of overvaluation of the naira was 15% before COVID. And then they've done 15% in all, almost 20%. You see, if you were to move, say 410 naira, the amount you would have mopped up that extra liquidity. Robert was talking about the increase in money supply. But what you don't realize that the amount of, when you sell foreign exchange and take out that liquidity, the amount of naira, the money, the dollars in the parallel market will reduce. And that is what has happened many times. So we're not going to sit down and speculate about what is the fair value of the naira. It is the methodology and the mechanism for determining an exchange rate, which goes from the terms of trade one to the balance of trade to your reserve cover and to your competitiveness with your trading partners. When you put all of these things together and you take away the fear and speculative premium, because the demand-supply gap, the demand-supply balance is probably at about 410 or 405 today. But when you add about the 20% premium for fear and speculation and rationing and the way it's being managed, that pushes the rates further. And I think that if you were to disperse all of these monies, first of all, you will reduce money supply. Secondly, you create a situation where people will now know that because the dollars are not going to be rationed, they will not front load their demand for foreign exchange. The foreign exchange demand will be exactly what it is, which is in an economy that has contracted by 8%. The demand for foreign exchange cannot be the same as it was before the contraction. So, I mean, it's very simple and straightforward. Well, basically, you have nothing to fear but fear itself. I think fear of policymakers, fear of the market, and speculation of people who are trading, who are making money out of this. I think that we need to address that. And once people now know that the central bank is going to be meeting the supply because the price of oil has increased, our multilateral donors are providing some funding, the World Bank, the AFDB, the IMF, they're providing some funding, the Eurobond market is there. You will find that there will be equilibrium and balance. And therefore, once people know this, that fear, the foreign exchange premium created by fear and speculation will disappear. And that is why I say it will come closer to where the non-deliverable forward rates are, and to some extent where the forward market is pointing towards the naira at this point in time. So I don't want to be quoted as to what exchange rate is fair value, but all I do know, when you take these steps, you will find that the naira will appreciate from that 475 naira to somewhere much lower than what it is, while at the same time we have done the same thing. We've moved our official rate a bit upwards to actually narrow the gap. And then we'll adopt a crawling peg method to ensure that the rate appreciates and depreciates. Remember, and I'll say this very quickly, that when the price of petrol, when the oil price went down, we went all the way down to 123 naira. Now, and the people say the world will come to an end. The world has not come to an end. We are at 148.7. The price of oil increases. The Nigerian customer is willing to pay for the market as long as they get supply. Absolutely. And he knows that the government is not fixing prices. That is what the problem is. Right. So my view is that we should allow the market determine the fair value while we intervene to ensure that people are not exploited. Thank you.
Right. Now, Robert, the MPC, of course, is preparing to meet in September. So what do you expect to see? What does the market expect to hear from the CBN, given the GDP number now and, of course, all these issues around the exchange rate? A quick one.
Yeah, definitely. I think the MPC would want to act, and if you read the past communique, these are things that they have reiterated, over time. But I also think that there are certain, policy measures that they may not want to go the route of, such as, tweaking interest rate per se. Now, the reason is because, we've all argued that the MPR seems to be losing its, potency. The central bank can use the OMO bills or OMO rate to actually direct where they want interest rates to be. I think most of the policy measures that will come up may not be, tweaking, macro indicators, but will be some of, central banks' unconventional policy to, managing the monetary policy system.
All right, thank you very much. It's been a wonderful outing with you.
Yeah,
I have Mr. Bismarck Rewane, CEO of Financial Derivatives Company. Thank you very much for your time. And of course, Robert Omotunde, investment professional. Thank you very much for your time.